Hey guys, John Brown here. Welcome back to Exploring Park City Living, and today we're going to be talking about the decision to pay off your mortgage early or invest in more real estate or stocks. This is one of the most significant financial choices people face. So, most times owning a home is usually someone's biggest asset, so choosing incorrectly could mean missing out on tens or even hundreds of thousands of dollars. So, everyone's position is different, so hopefully this video provides insight and factors to help you make your own decision. So let's get into it. I am actually mounting up some skis today, so we will be going along mounting some skis and talking about opportunity cost, pay down. All right, so benefits of paying off a mortgage early. So, big benefit is reduces debt and a big peace of mind. So, a lot of people just don't like having debt, especially if you're older and you want less risk and just a peace of mind that you don't have a large monthly payment. Paying that down is going to be priceless for most people in that thought process. So, it also builds up equity in the home faster while you're saving on interest. It frees up, money for essential expenses like food, energy, travel, just all the other expenses of life. So, one way people like to do it that is pretty common is half bi-weekly mortgage payments. This can save money on interest and reduce the mortgage term by 4 to 6 years. This equals to an extra full monthly payment each year. So, for an example, on a loan amount of $1 million at 5% interest rate, doing biweekly payments will pay off 4 years earlier, savings of $100,000 in interest. Note, while doing this, you're paying about $5,000 extra each year, totaling $125,000 in extra payments throughout that 26 years because you're paying it off 4 years earlier. So that is the opportunity cost that we're going to be talking about. If you want to do bi-weekly payments and pay it down more, that's $125,000 you could be investing. So $5,000 a year invested for 26 years, that's $125,000 invested throughout the 26 years. With an annual 7% return would yield you a total of $343,000 and in total and $213 in profits. So, an example where you have a 5% loan amount and you want to do biweekly, you're saving $125,000, but if you invested it at a 7% return, then you will profit $213,000. So, sorry, the savings was $109,000, and so yes. But anyways, if that same loan though was 7%, the spread between what you could get as an investment return versus pay down gets smaller, and the risk seems less enticing, right? So if you had a 7% mortgage, then paying that down is a 7% return, where in the stock market, it usually yields 7 to 10%. You might as well just pay off your mortgage because you're getting that 7% return guaranteed, where benefits in the stock market are endless. Like if you put money into Nvidia 5 years ago, you would have had a 2,000% return in growth. But in the last 5 years, yeah. But picking stocks is so hard. So investing in index funds like the S&P 500 or NASDAQ can yield you consistent annual returns on average of 7 to 10%. So if you're a strong investor and you have a strategy and you are a little bit more keen to risk for more upside, then investing could be for you. But picking individual stocks is so hard, and a lot of people don't like. It's really hard to beat the market, the average, that 7 to 10%. So if you're thinking you can do better on your own, then you're probably not watching this video. So, but anyway, all right, guys, I'm sitting down while doing this so you can see what's going on. These have been drilled before. You can see holes here. They were my buddy Colby Stevenson's. You can see some stickers. I did ski World Cups for 10 years and I had many sponsors, but ever since being in real estate full time, I just haven't really had the energy to go out and get sponsors. So huge thanks to friends like Colby to give me some of their backup skis, as I don't really have the effort to go out and get a sponsor for not that much money. Like, if a really good sponsor comes by with a great deal and a brand I really like, then I'll do it. But making real money in real estate, I like to just kind of ski whatever I want now. So very nice. So this is the back. So this is called a jig. So these are very, very hard to come by. And so these are for FKS bindings. I have these old Look bindings, Look FKSs. They've got a swivel heel for like knee releases that are good for not blowing your knee. I also like putting these on my park skis because they are up to 18 din, and I like having my dins at like 14, 15, because when you're skiing park, grabbing, and sometimes I rip my skis off in the air, which is scary. You can see right here there is a stopper. So when you're in here, it's perfectly perpendicular to the ski, and there's a stopper so it doesn't go too deep. So alright, boom, we got it done. So the other ski is going to be the same thing, so I'm not going to bore you with that, and I'll do that after. Hi, you guys want to say hi to Millie? Millie came through. Oh. And Millie gave me a good idea that if you have a 3% interest rate on your mortgage, then it most likely is not a good idea to pay off your mortgage earlier. That's because with a Fed having a target rate of inflation of 2% and your interest rate of only 3%, when you account for inflation, you really only have a 1% rate when you're hedging for inflation. So rather than if you have a 7.5% interest rate, then paying that down is going to be a little different because you effectively have a 5% interest rate, not a 1% interest rate, accounting for inflation. So, and if you have a 7.5% interest rate and you're trying to invest in the stock market to get a 7 to 10% return, it might not be worth investing in stocks for the possible downsides. So those things to note as well. Also, I'm going to have to talk about refinancing. Refinancing is a really good strategy. I'm hearing it a lot right now. You can always refinance later, and that is true to a certain extent. Refinancing a mortgage at a lower interest rate can provide a middle ground by reducing monthly payments and freeing up money for investments, etc. But there are risks with always being able to refinance later. Say the real estate market goes down and you buy a house for $1 million and you put 20% down, so you have an $800,000 loan, and rates come down, but also the value of that home goes down. I know there's only been a few instances where values of home trends down considerably But it could happen. So imagine if the home goes down 20%, like we saw in the Great Recession. So now the home's only worth $800,000 and you have $800,000 loan on it. So if you want to refinance, then you're going to have to put another 100 or 200,000 down to just be able to refinance, because your loan to value ratio is going to be almost upside down or close to upside down. So you got to know that if you refinance, the value of the property has to stay the same or higher. And number two, you have to qualify for it. So if your income is up in the air, or you think you might switch industries, then refinancing in the future might not be possible for you. So you gotta note that refinancing later is a really good strategy, especially right now, but you have to know the risks along with refinancing. So anyways, closing points. Each person's situation is unique. This decision depends on individuals' goals, finance circumstances, and risk tolerances. So online tools also are amazing alongside professional advice. Can provide clarity. There's like mortgage calculators is what I was talking about with online tools. So there's mortgage calculator pay downs. Just type it in to Google and you'll find one of those. But if you'd like more individual breakdown or would love for me to help you out, I would love to do that for you. If you're looking to buy or sell, hit me up. Love to help you there too. So see you guys, and I'm gonna go mount these things and go skiing. Peace.